Hello everyone. Today we are going to talk about domestic and international dimensions of monetary policy. So, are you all excited to know more about this topic? In this chapter, we have several learning objectives to identify the key factors that influence the quantity of money that the people desire to hold, to describe how the Federal Reserve's monetary policy actions influence the market interest rates, to evaluate how the expansionary and contractionary monetary policy actions affect the equilibrium real GDP and the price level in the short run, to understand the equation of exchange and its importance in the quantity theory of money and prices. Last but not the least, to explain how the Federal Reserve have implemented the credit policy since 2008. So let's start talking about money. Learning objective 3, to evaluate how expansionary and contractionary monetary policy actions affect equilibrium real GDP and the price level in the short run. Let us now discuss the effect of increase in the money supply. Have a look at this image. What do you see here? What is happening here? There is a helicopter. Some papers you can see here. That's actually some dollar notes. There are people on the ground who are running to receive this cash money. Now let us suppose that one day a helicopter flies over the Lake Havasu community and it drops at additional $1,000 in bills from the sky, which is of course collected from the people of Lake Havasu community. Let us suppose further convinced that everyone is convinced to receive that money, and because this is a unique event which will never be repeated. So, what do you think? What impact it will have when there is so much of funds with people? Just think, just imagine. Of course, first people will pick up the money, put it in their pockets. But how do they dispose of this new money? Think, think, think. Well, this concept is called as helicopter money, and it appears to have originated with Milton Friedman. Helicopter money is a proposed unconventional monetary policy, sometimes suggested as an alternative to quantitative easing when the economy is in liquidity trap. Liquidity trap occurs when the interest rates nears the zero and the economy remains in recession. Although the original idea of helicopter money describes the central banks making payments directly to the individuals, economists have used the term helicopter money to refer to a wide range of different policy ideas, including the permanent monetization of budget deficits, with additional element of attempting to shock beliefs about the future inflation or the nominal GDP growth in order to change expectation. A second set of policies closer to the description of helicopter money and more innovative in the context of monetary history involves the central bank making direct transfer to the private sector financed with the base money without direct involvement of fiscal authorities. The name Helicopter money was first coined in 1969 by Milton Friedman when he wrote a parable of dropping money from a helicopter to illustrate the effect of monetary expansion. The concept was revived by the economist as monetary policy proposed early in 2000 following Japan's lost decade. In 2020, the US legislative system debated issuing 2 times a $1,000 check to eligible adult citizen, which is described by media as helicopter money as a response to US coronavirus pandemic. However, this practice cannot be considered as helicopter money as long as the money is distributed or the money is distribution is financed by the state debt, not by the central bank. Specifically, the money printing based on the monetary expansion. Let us see the effect of increase in the money supply. Direct effect as well as indirect effect. First is direct effect. Now just imagine if you have excess money balance with you, what you'll do? Obviously, you will go to different shops, you'll buy variety of goods and services, you'll purchase that. It means we have a direct impact on the aggregate demand. With the increase in money supply, what is happening? The aggregate demand is rising at a particular price level. So people are interested to have more of the real goods and services. Let us see what is the indirect effect on the increase in money supply. Now, not everybody will spend their money on the goods and services. Some people, they will wish to deposit a portion of these excess money balances in the bank, right? Now, banks have sufficient funds with them. They have higher reserves and they can lend out the excess one. For that, bank strategy will be to reduce the interest rate so that it can attract, it will induce more borrowings. The customer will be interested to have more loans because of the lower interest rate. Let us see from business point of view and individual's point of view. Now, when loan is offered at lower interest rate, businesses will go for loan and that money can be used for investment. Individuals, now what they will do, they can get loan and spend on the durable goods, sometimes on housing, sometimes on automobiles. So all those durable goods will be again demanded. Increased loan will generate increase in the aggregate demand. More people, even those who didn't get any money from the helicopter, are involved in more spending. My next point is contractionary monetary policy. Contractionary monetary policy is when a central bank uses the monetary policy tools to fight inflation. Since inflation is a sign of an overheated economy, the bank must slow economic growth. It will raise the interest rate to make lending more expensive and the money supply decreases. It is also known as a restrictive monetary policy. As we know that US is the central bank, like US central bank is the Federal Reserve. It has the target for inflation of 2%, and if the inflation is higher than that, it means the economy is overheating. If it is lower than 2%, it is indicating that there is sluggish growth. So you can see here the chain that I have provided about the effects. Banks charge higher rate on their loans to compensate for higher Fed fund rate, and when there is higher interest rate, Business borrow less and do not expand as much as and hire fewer workers. That reduces the demand, and as the people shop less, farms slash prices. Falling prices lead to inflation or lead into the inflation. Fed also uses the open market operation. When Fed buys or sells its holding of US Treasury note to implement the contractionary policy, the Fed sells treasuries to one of its member banks, and the bank must pay the Fed for treasuries, reducing the credit on its books. As a result, the banks have less money available to lend. With less money to lend, they charge higher interest rate. It has same effect as raising the Fed's fund rate. Falling prices put an end to the inflation. The next tool is expansionary monetary policy, and this happens when the central bank uses its tool to stimulate the economy. In this case, it increases the money supply by lowering the interest rate, and when the interest rate is low, it increases the aggregate demand for goods and services, and then it boosts growth, which is measured by the GDP or the gross domestic product. It lowers the value of currency and thereby decreasing the exchange rate. The US Central Bank Federal Reserve is a really good example of how expansionary monetary policy works. So you can also see here the chain of impact. The Fed uses the open market operation tool. It buys the treasury notes from its member banks. Where does it get the funds to do so? That's what people mean when they say the Fed is printing money. By replacing the bank's treasury notes with the credit, Fed actually gives them more money to lend. To lend out the excess cash, what the bank do? They reduce the interest rate or the lending rates, and that makes loans less expensive for specifically for different categories of loans, for auto, school, or we can say education, home, etc. They also reduce the credit card interest rate. All of these activities lead to a boost customer spending. When business loans are more affordable, companies also expand to keep up with their customer demand. They hire more workers, the income rise, and allowing them to shop even more. And that is usually enough to stimulate the demand and drive economic growth to healthy 2 to 3%. You can see here there is figure relating to the expansionary and contractionary monetary policy, and there are like two panels, two different figures to explain these two policies. So let us first focus on the first one, that is the expansionary monetary policy with underutilized resources. So here, if we start out with equilibrium at E1, expansionary monetary policy will shift AD1 to AD2, and the new equilibrium will be at E2. Okay, so just consider the effect of monetary policy on the real GDP and the price level. For this, what we have to do, we have to begin with the situation in which the economy is operating at less than full employment. So you can see a recessionary gap in the figure, which is measured as the horizontal difference between the long run aggregate supply curve, that is represented as LRAS, and the current equilibrium. The short term equilibrium is at E1, as mentioned over there. SRAS is the short run aggregate supply curve. So the short run equilibrium is at E1 with the price level of 120 and the real GDP at 17.5 trillion. The long run aggregate supply curve is at 18 trillion. And now assume that the Fed increases the money supply. Because of the direct and indirect effect of this increase in money supply, aggregate demand shift outward to the right, that is to 82. The new equilibrium is at output rate of 18 trillion of real GDP per year and a price level of 125. So, here the expansionary monetary policy can move the economy towards its long run aggregate supply curve sooner than otherwise. The next one is figure 16.4 relating to the contractionary monetary policy. Assume that there is a inflationary gap as shown in this figure. There you can see that the short run aggregate supply curve, which is represented as SRAS, intersects the aggregate demand, that is AD1, at E1. This is to the right of the LRAS, or the real GDP per year, of 18 trillion. Contractionary monetary policy can eliminate this inflationary gap. Because of the both direct and indirect effect of monetary policy, the aggregate demand curve, it shifts inward from AD1 to AD2. Equilibrium is now at E2, which is at the lower price level, that is 120. Equilibrium real GDP has fallen from 18.5 trillion to 18 trillion. So, just to summarize, if we begin the short run equilibrium at E1, contractionary monetary policy will shift the aggregate demand curve from AD1 to AD2, and the new equilibrium will be at E2. There is a concept called as quantitative easing. What is that? The Federal Reserve open market purchases intend to generate an increase in bank reserves at a nearly zero interest rate. Okay, so that focuses on the quantitative easing. A higher level of interest rate will actually reduce the business investment spending. Also, household will cut back their consumption of loan financed durable goods. The resulting reduction in the total plant expenditure will generate a decrease in the aggregate demand. Assume that there is a recessionary gap. When the economy is operating at less than full employment, expansionary monetary policy can close the recessionary gap. Direct and indirect effect cause the aggregate demand curve to shift outward. Contractionary monetary policy can eliminate the inflationary gap. Direct and indirect cause the aggregate demand curve to shift inward. And here assume that there is inflationary gap. Let us now consider the net export effect of contractionary monetary policy and expansionary monetary policy. So, let us first focus on the net export effect of contractionary monetary policy. Such policy will actually, boost the market interest rate, and higher rates will attract foreign investment. The international price of the dollar will rise, and appreciation of dollar reduces the net exports, and there is negative net export effect. Now focus on the expansionary monetary policy. The interest rate will fall, financial capital flows out of the United States, demand for dollars will decrease, international price for dollar will go down, foreign goods look more expensive in the United States, net exports increase and imports fall. Consider the globalization of international money market. Fed's ability to control the rate of growth of money supply may be hampered as the US money market becomes less isolated. If Fed reduces the growth of money supply, Individuals like you and me and farms in United States can obtain dollars from other sources and can more regularly conduct transactions using other nations' currencies. Thank you very much for paying attention to the lecture. Please feel free to post any questions, anything that you do not understand from this chapter, anything for which you need more clarification. Just drop me an email or message me on Canvas discussion board. Even you can use the Google Doc that I have shared with you. Learning is very important, and I'm here to help you to learn. Thank you very much.